Welcome to Retirement GPS, navigated by Zane, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome back, ladies and gentlemen, to the 35th episode of our Retirement GPS podcast. I'm your host, Ryan Zaharchek, Certified Financial Planner and President of Zane Retirement Planning.
And I'm your co-host, Zane Belsack, Associate Planner here at Zane Retirement Planning. We're really going to look at one of the most common retirement questions that we often hear, which is what happens to my plan if the market drops 20%? Really, the goal here in this episode is to find out what a 20% decline really means and how volatility really affects those retired compared to those working and contributing, really what sequence of returns risk is, and how disciplined portfolios really design and protect retirement income. Hopefully, by the end of this episode, you'll understand that a market drop doesn't automatically mean that your retirement plan is broken, but you really know what the safeguards will be and how they're already in place. And I mean, we have some experience with this, don't we, Ryan?
Yeah, absolutely. I have a great story. This is one of the benefits of actually being in this business for a while, coming up on being in this business more than 20 years. And it goes back to the financial crisis, which was what I like to call the granddaddy of market declines, at least in our lifetime. It was about 16 years ago. And I started working with a gentleman who happened to retire pretty much the worst time, again, of our lifetimes to retire, which was the late summer of 2007. Now, the financial crisis technically started, or at least from a market decline standpoint, started in October of 2007. So the equivalent of retiring in summer of 1929, right before the Great Depression. And the timing, obviously, was a big deal. We put together a financial plan for him. We put his money to work. He retired. And then we just start off in October of 2007 with nothing but a falling market. And over the next 20 months, the market proceeded to fall more than 50% from its highs to its lows. The good news is that we had a balanced portfolio in place for Fred, and he didn't feel the entirety of that market pain, even though he was watching it on the news every day. But at his lowest point, his portfolio had fallen a little bit less than 25%. So he felt roughly half the pain of the market due to asset allocation. However, pain is pain. If you're retired and you see the market fall day after day after day, you're worried. And Fred was worried, for sure. We discussed the original plan, and he actually came back to me and he said, am I going to be able to stay retired? I just retired about a year and a half ago, and here it is. The market just keeps falling. I'm down quite a bit of money, and I'm not sure I'm going to be able to survive. The good news is that we were able to pull out his original plan, go through it, and look at the stress test that we put in place before the market began to decline. Now, we stress test all portfolios against market declines because one of the worst things that can happen to you is you retire right at the beginning of a bear market, and that's exactly what happened to Fred. We looked at the stress test, and the stress test compares him to the Great Depression. And we actually ran a 20% decline for 3 straight years to make sure that he could survive it. And his retirement did survive that type of decline. So Fred definitely took some comfort in understanding that we did plan for this. And we were only at the time about 18 months into the correction. It was going to be a total of 20 months, now that we know with hindsight, before it started moving up again. He was pretty worried at the bottom, but we were comfortable that he was going to be okay. And I said to him, as long as we don't experience this for another 18 months, you're going to be fine. And even if you do, as long as it recovers from there, you should be fine. So we held to the strategy. We rebalanced through the correction. So what we mean by that is, as the market was correcting and bonds were doing well because interest rates began to fall, we were selling our bonds and we were buying stocks at cheaper prices and maintaining his diversification. He was actually a 50% stock and 50% bond for portfolio at the time. And we started to move him actually to a more aggressive stock portfolio. So we actually went to 70-30 by the end of the financial crisis. And that worked out really well for Fred because things turned around and it didn't take very long. By the end of 2010, he was back to where he started and just moved higher from there. worked with Fred for the next about 15 years until he passed away. And he never had to change his lifestyle, never had to change his income. And he was comfortable the entirety of his retirement. And he actually passed away with more money, significantly more money than he started with. But here's what really mattered most is that, number one, his plan was built for this. We designed a plan specifically to withstand this type of correction. We had a structured income strategy. We had cash reserves and a diversified portfolio designed with retirement in mind. And clearly, this is an extreme example. This podcast is about a 20% decline. I just described a 50+% decline. But even in that scenario, Fred's retirement was not affected. He worried. I'm not going to lie to you. I can't imagine you're not going to worry if you go through a massive recession in your retirement. But his worries were unfounded and short-lived. And that's really our goal. So that's what we want to accomplish.
I think that's such an important lesson, especially I understand it's a bad time, but when you're investing for the long term, and even as you were saying, Ryan, his portfolio ended up being greater than when he started, which is amazing. I think that's something to really consider. It's also important to consider the basics, and some of the basics are what really is a 20% market drop? What does that mean? What are we looking at when we're talking about a 20% market drop?
Yeah, it's a great question. A 20% market decline is something that we actually call a bear market. That is the definition of a bear market in investing circles. So when you hear the term bear market, usually it means a 20% market decline. Market correction is defined as a 10% decline in the market. So these corrections are, it's important to understand, very common. I do not work with somebody who's starting retirement and say to them, hopefully you won't experience a bear market or a market correction. I say the opposite. I say you will experience a market decline, a bear market, and a market correction. In fact, you're going to experience probably many of them. If you're retired for 30 to 40 years, which we hope for you, if you retire at 65 and you pass away at 95, that's a 30-year retirement. You can expect an average of a 20% decline every 3 or so years. Now, I want to be clear about that. It doesn't mean they're going to be every 3 years on center, right? That's what everybody expects. Oh, it's been 4 years of decline. We're due for one. And the truth is, maybe we are, maybe we're not. But there have been periods of 6, 7, 8 years where we haven't had a decline, a correction. And then we've had 3 corrections in a period of a year and a half. So these are averages, right? And a lot of times when it comes to averages, we get these things chunked together. So 20% declines can happen 3 times in a year and a half, or they could happen 0 times over a 7-year period. But on average, every 3 years is when you can expect a 20% decline. So if you're retired for 30 years, get comfortable with a 20% decline 10 times. That's a significant number of times. And on occasion, they'll be far worse than that. That 50% decline is a rare decline, but it does happen, as we see. You just have to be comfortable with that. Also, you have to be comfortable with volatility as being a part of your investing. So we talked about a 20% decline every 3 years. You can expect a 10% decline every year, and a 5% decline on average 3 times a year. These are all averages. And like I said, that doesn't necessarily mean they're going to happen this year or next year, but these are averages. So they are a just foundational part of investing. In order to get higher returns in a diversified portfolio or in the stock market, you have to sit through volatility. You have to sit through declines. But here's the good news, is that recovery historically follows those declines and those downturns. We have had extended periods of downturns. You're talking about the Great Depression, 2000 to 2010. We had the tech bubble bursting. We had a bit of a recovery and then the financial crisis following it. So we do have extended periods of bear markets, and those are very typical, but they're rare. They do happen, and we just need to be prepared for them. But for the most part, if we get a significant decline, waiting it out, like cashing out your chips and sitting on the sideline waiting for it to get better, means you're going to miss that highly probable significant recovery on the back end of it. And that recovery comes quick, and usually comes way too quick for people to even realize it, because most people say, I'll wait till it gets better. I'll wait till the economy's better, the job market's better. And my answer is, by then the market's up 50% from where
well, too late.
Too late. Absolutely. You would have to reinvest when things look their darkest, when things look their worst, and when the market is at its absolute bottom. The market bottomed in March of 2009 in the financial crisis. I actually think it's March 9th. I think I have that. And I saved that newspaper clipping. And it was interesting because the Wall Street Journal on March 9th, which was the bottom of the bear market, has GM going out of business and people all losing their jobs and all GM shareholders losing everything. It has Ford laying people off. The headlines were horrible. Market at 10-year lows. These were not optimistic headlines. And that was exactly the best time to buy, probably in our lifetime. I think the Dow was about 6,500.
And you've touched on this, but when you're using really good strategies such as rebalancing or investing when it's low, it makes the recovery so much sweeter.
Absolutely, yeah. And the point is here, and actually the high level point where we're trying to talk about is timing these things is darn near impossible. It's not something that you should be trying to do or attempting to do. Professionals can't do it successfully and consistently. So as if you're an amateur listening to this, what makes you think that you can do it? I can tell you I can't do it. And I've been in this business. I've been actually in finance for 30 years, both on Wall Street and in personal financial planning. And I have no idea. I do know when the clouds are the darkest, usually that is the best time to buy. But I'm wrong on that front too from time to time. So we don't try to time the market. It's have the good strategy, go into it with the right strategy. And in the case of Fred, we had that 50% stocks and 50% bonds situation, which was fantastic. What we started to see was as bonds came higher and higher demand because people wanted safety and certainty, and the interest rates fell, those bonds did really well because rates and bond prices are in inverse relationship. So interest rates fell and rates were falling, went to 1.5% and 2%. So why would we want half of our portfolio in bonds that were paying 1.5% to 2% when the stock market was as cheap as it's been almost in a generation, but nobody wanted it because it just had fallen for the last several years. So everybody said, I just don't want stocks. We were selling our bonds and buying stocks. We didn't do it wholesale. We didn't sell 100% of our bonds and buy 100% of our stocks. Probably would have been not very smart from a risk standpoint, but we definitely got more aggressive in the portfolio as the market declined. I did not know where the bottom was. I wasn't predicting the bottom. I was just saying bonds are getting expensive, stocks are getting cheap. We're going to start making a move more towards stocks. It's not really about predicting the future. It's more about looking at historical valuations, where things are, and setting up your portfolio for future success.
Some people say that they can predict the future, so
they say that.
They say that.
They typically are weathermen, so let's see how that goes. So the thing that we want to be really sensitive to when we're looking at volatility and a market decline and how it impacts us is the sequence of returns. Sequence of returns is really the thing that we as financial planners, and as you study in CFP, you understand that an average rate of return is nice. And typically this is where my people get tripped up when they're talking to me and saying, the average rate of return in the S&P 500 is this, and your return is that. Why is it not as good as the S&P 500, especially in the last few years when the S&P 500 has done so well? And our answer is because we don't want to be 100% in the S&P 500, right? Because the S&P 500 is a great index for tracking large cap stocks, but the problem is it's extraordinarily volatile. And especially for someone near or in retirement, it's way too volatile to have 100% of your money in, because the average rate of return of the S&P 500 may be pretty high, 9 or 10% over a long period of time. The problem is that average doesn't tell you about its volatility, and the volatility can be extreme in the S&P 500. We can have years where it's down 20 and 30% consistently year after year, as we saw in the tech bubble bursting, as we saw in the financial crisis, as we saw in the 70s, as we saw in the 30s. These periods happen, and when they do, they can destroy a portfolio of retirement, because sequence of returns is what we call really important. So think about it this way. I like to use the analogy. I've used it in this podcast before. I always say if I'm in the kitchen and my head is in the oven and my feet are in the freezers, we miss a very important component of our investing, which is the volatility, the extreme highs and lows of that average. So if I average 9%, but my extreme high is 50%, meaning I get a 50% return one year, but I get a negative 40% one year, and on average it averages out to 9 or 10%, that can be problematic when we're drawing on our portfolio and we're pulling cash and principal from the portfolio to live comfortably. We expect a certain rate of return to make up for those distributions. But what happens if early in our career, early in our retirement, I should say, early in our retirement, we are drawing from the portfolio a 4 to 5% distribution rate, and then the portfolio is falling 20, 25, even 30% year after year. We are digging a hole and then digging it further and further. And then what happens is when the market turns around and we get those high 30, 40, and 50% returns in a year, we don't have enough money there to make enough back for what we've taken and what we lost, because we were digging our hole deeper and deeper during that correction. So sequence of returns is really important. The big thing that we want to look out for is losses combined early in our retirement, which affect compounding long term. If it happens later in our retirement, it's not as big a deal. Somebody's 80 years old and we go through a financial crisis and they have a portfolio set in place. I'm not concerned about it. I am concerned with a 65-year-old because they have a lot of years left to get through. So it's really all about those early years.
And their portfolios are already somewhat established, right, as an 80-year-old compared to a 65-year-old in relation to bonds and stocks?
They're all established. They go into retirement. They go into their investing life established if they're working with us. It's more to the point, if you're an 80-year-old, you just don't have a lot of time. If there is a correction, you don't need to have 30 years of distributions where that correction can actually affect you from a compounding standpoint. You typically can survive a correction without too much trouble.
I also think that we should get into a little bit of some strategies, and I know we already touched upon a couple of them, but starting to talk about some of these strategies so people know exactly what to look towards.
Yeah, if you have a market decline and you're trying to avoid sort of the pain or the emotional pain of it, what are the things that we can do? We can't avoid market declines. If we're going to invest over time and we want to keep up with inflation, we have to invest in the stock market to some degree, right? That's what a diversified portfolio is. A percentage of that should always be in the stock market. And in my case, the people I work with, it's almost always a minimum of 50%. So half your portfolio is almost always invested in the stock market, which means you're going to experience up and downs and volatility. But what can we do to avoid making a bad decision and having that volatility affect us? The first one is develop a plan and stay committed to it. So once you have your diversification, once you have your plan in place, move forward with it. That plan should always stress test against volatility. If you are planning and not testing against a significant decline multiple years in a row, then you're missing a major component of risk management. Make sure you're staying committed to your plan as long as your goals remain constant. If your goals change your plan, we can talk about that. Don't change your goals just because the market's corrected. Now my goal is to preserve capital and not grow my capital. That's a bad goal, and that typically leads to bad decisions. In the time that I've been doing this, the corrections that I've experienced, the people that have screwed up their retirement are not the people that invested and stayed invested. It's the people that made emotional decisions, both either greedy decisions or fearful decisions. During times when the market's really good, they get too aggressive, and during times when the markets are really bad, they get way too conservative. That will actually screw up your entire future and your retirement, which we don't want to see. Stay committed to your plan. If your income needs change, then obviously you can update your plan to make those changes and make sure that your allocation matches your risk tolerance, but be careful not to change your risk tolerance just because the market is falling. So that's a really important part, is develop that plan and stay committed to it. Number two is maintaining cash reserves. We're getting a lot of pushback today on people with cash reserves, where you may be retired and they may have $40,000 or $50,000 in emergency reserve, and we're telling them to have 80. And they're saying, but why? It's just a lot of money sitting there doing nothing. First of all, that's not true. Most savings accounts today are earning, high yield accounts anyway, are earning 3.5%, maybe even 4% on your cash. You're mitigating that gap. We typically tell people you can expect around 7 to 9 in a diversified portfolio over time. So 4% is not terrible. Secondly, that is that safety net, that cushion to allow you to sleep well at night when the market is doing its volatile thing and having a really tough time, to know, hey, listen, I've got roughly a year's worth of living expenses in cash. I don't really need to touch these stocks until they recover. And again, if we have the right diversification, the bonds should typically be doing pretty well. When the stocks are doing poorly, you've got your cash you can draw from. We can draw from the bonds in the portfolio. We got a lot of cushion there to let this market ride itself out and really keep you from panicking in the stock market during a tough time. Number three, rebalance when necessary. So rebalancing is important, and we talked about that in Fred's case. In Fred's case, that wasn't just rebalance. We actually shifted the portfolio to get more aggressive as stocks got cheaper and cheaper. But a rebalance is if we were simply in a portfolio of 50% stocks and 50% bonds, if your stocks fell 20% and now you're 40% stocks and 60% bonds, we want to sell some of those bonds, even though they've been doing well, and buy stocks and bring us back to 50-50. That's what a rebalance is. And it's a very hard thing to do in a market correction. It's a very hard thing to do anytime, because in a great market, nobody wants to sell stocks that are doing well to buy bonds that are doing poorly, and vice versa. If stocks are doing really poorly, nobody wants to sell their bonds that are safe and making them money and guaranteed to go buy risky stocks, quote unquote risky stocks. That's what we want to do during that time, is we want to overcome the little fear man sitting on our shoulder telling us not to do it, and make smart decisions, because what we're doing is we're selling high, we're buying low, and we keep our portfolio in balance so that when the correction is over and the recovery does come, you're able to maximize that recovery and get a great rate of return.
It's important to keep an eye on this, considering if we had, say, a really good market and you were 50-50 and then your stocks ended up going up to 65 and then your bonds ended up going down. Now you're at a riskier portfolio.
Correct. Yeah. And that's the problem because typically those major corrections come after really good periods. The 2000 to 2010 bear market, which had two major corrections, which was the tech bubble bursting and then the financial crisis, came after the 1990s, which was one of the best periods for the stock market in history. So if you didn't rebalance through the 90s, you experienced a lot of pain through 2000 and 2010. And I got to be honest with you, you probably just wasted a lot of time. Basically, everything would have been a lot better. The returns would have been better. The risk would have been less had you just been doing your rebalancing both during the good time and the bad.
So we have some strategies. Now, what's the rollout here? What do you think we should do during a 20% drop?
Yeah, great question. First thing you should do is turn off the news. Don't get yourself concerned about a 20% drop because whatever the reason behind that drop, it's going to make you think it's the biggest reason in the world. I don't care if that reason is that there is this new pandemic that nobody's ever seen before that is shutting down our economy. That's going to be the end of global trade as we know it, i.e. COVID during 2020. It could also be a trade war that begins with every single country in the world against the United States, and the market continues to sell off. And we have a president who insists that we're going to be doing this regardless of what's going on with the stock market. And your politics may say that you don't like this president, and that may seem like the end of the world to you. These are examples of 20% drops we've experienced just in the last 5 years that seemed basically, and actually the conversations I had with people during that time was, yes, but this time is really different. This is different. I'm telling you this is different. And my answer is it's not different. Every crisis is a crisis. Every crisis feels like it's the end of the world. They're all the same. If there's nukes in the air, that's probably slightly different. And if that's the case, I wouldn't really...
Why would you care about your investments?
I worry so much about your investments.
Yeah.
A great Wall Street trader once told me, he goes, if you hear a rumor that nukes are in the air, you buy the stock market. Because if the rumor is correct, it really doesn't matter anyway. The trades will never settle. And if the rumor is wrong, the market's going to rally as soon as the rumor is debunked. So it is a really great point. If people are talking about this time is different, this time is the end of the world, and there's that much fear, that usually means it's time to buy. Because if those people are right, then your 401k, your financials probably don't matter so much because we may not even be around to enjoy them. And if the rumor is wrong, then you're going to make a lot of money on the back end.
It's always good to hear. Take some good news out of the bad.
Yeah, take some good news out of the bad. Now, that was a long-winded way to say turn the news off. But I do think it's really important that people work themselves into a frenzy over the news that they watch. Review your financial plan, assuming that you have one, not just your account balances. And talk to your planner if you have one. Make sure that you're talking through, what does this mean for me? Does this matter? Because my answer to my people is, it doesn't matter. This is not anything that we haven't anticipated or don't expect. Just sit through it, turn off the news, and go live your life. Confirm that your income buffers remain intact. Unfortunately, if you don't have your income buffers, it's a tough time to build those income buffers. If the market's already down, you don't want to go selling stocks to put money in cash and emergency reserves at that time. But those income buffers should be intact so that you have that emergency reserve and the income coming in to support your lifestyle. Evaluate the allocation drift. So if you're getting away from the original portfolio, it may be time for a rebalance. And just make sure that you're avoiding sudden allocation change. If you're making a decision on the fly based on how you're feeling, you are making a mistake. I can almost guarantee it. And there's probably a 95% chance you're going to be wrong, far more wrong than you are right. Just take that and think about it logically before you make that emotional decision.
Right. So now we're going to move into a new segment, and we want to thank everyone for inputting some questions. We're going to look at some listener questions. We have a couple. I'll ask our financial planner, Ryan, to answer a couple of them. The first one is, if the market drops 20% and I'm already retired, should I reduce my spending temporarily?
Yeah, that's a good question. People have asked me that. The short answer is if your plan is done right, you certainly don't have to. If you want to do something to make yourself feel better that you can control that would improve your financial situation, then absolutely, that is one way to do it. If you reduce spending, it's just less money that you have to draw from your portfolio in a time when it's down. So the answer is no, you shouldn't have to, but if you want to, it would help.
Great. I really like this question. If I retire right before a market crash, should I consider going back to work?
That's a great question. And the answer is we do not, again, very similar to the prior question, we do not require that or request it. We build financial plans to survive market crashes, so you shouldn't have to go back to work. If you want to go back to work because, once again, you feel like you don't want to reduce your spending, but you want to control something that you can control in your financial life, going back to work may help. And if you want to do that for lifestyle reasons and have a little extra pocket money and reduce the distributions that you take from your portfolio, then I say, God bless you, go off and do it, but you shouldn't have to do it.
I was going to say, if your plan is done the right way, all that outside noise really shouldn't matter.
Nope. And again, these are all decisions that you can make really more to make yourself feel better, but it shouldn't really affect the financial plan.
All right, so I'm going to ask one last question. I'm actually going to add on to it. So the original question was, how often should I review my plan during a volatile year? And I'm going to add a little portion and say, is there a certain way that you review your plan? Do you base it off of stocks and bonds going a certain way?
Boy, that's a great question. So how often should I review my plan during a volatile year? So let's just start with, in a normal year, I like the idea of reviewing your investments, reviewing your plan once a year. That should be plenty. If you review your investments in your portfolio and your plan once a year, it allows you the ability to rebalance. It allows you the ability to avoid the noise, like the short-term ups and downs. If you looked at, let's use 25, which was last year, S&P 500 was up 16% last year, but it was down 20% in 2 weeks in April because of what was going on with tariffs in Washington. If you watched your portfolio every single day, you'd lose your mind because it was just all over the place, especially in that spring. If you looked at it once a year, you'd look at it and be like, oh, good year. Not much happened, it looks like. But really is all perspective, and it's zooming that lens out. Same thing with your financial plan. Now, I know the question is, what about in a volatile year? And that is a good question. In a volatile year, I would check your plan if you're worried. You still don't have to check it more than once a year, but if you're worried and you say, I just want to review things and make sure everything's okay, just to make yourself feel better, do it as often as you feel necessary to make yourself feel better. As far as checking your portfolio, you can check your portfolio every few weeks or something along those lines to look to see if it just needs to be rebalanced if you're handling it yourself. If you're having a professional do it, they should be rebalancing for you. We rebalance based on drift, not time. We talked about that in a prior podcast, which means if we have, a 20% allocation to the S&P 500 and it drifts more than 30% from that allocation, which means it goes to 26 or down to 14, we run a rebalance on it, on the whole portfolio, and bring it back in line. So we have drifts set up automatically for different types of accounts. Taxable accounts are 30%, IRAs are 20%. We just rebalance taxable accounts less often just for tax purposes. And you can do the same. You can follow that model. You can just rebalance whenever you want to. It doesn't hurt. If the market's falling and you think it's pretty temporary and it just keeps falling and falling, it definitely doesn't hurt to say, okay, my S&P 500 is at 18%. I want it at 20. I'm just going to rebalance the whole account. Do it. It'll make you feel better. It'll make you feel like you have a little control and you're not hurting yourself. More rebalancing is not necessarily a bad thing.
Great answers. Thank you. To close it off here, really a 20% market drop. I know it feels dramatic in the moment, but really having that set in stone retirement plan, having something that's built for decades, not news cycles, is really key here. It's important to remember that volatility is inevitable. It's going to come either way. Sequence risk is real, but really diversification, liquidity, and discipline are what really protects long-term retirement success.
That's it. And having somebody that you can talk to, having a good planner, whether that's us or someone else, is really important because...
Thank you for listening to Retirement GPS, navigated by Zenergy. To explore today's topic further, visit our blog mile markers at zenergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zenergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zenergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.
I can tell you right now, a planner worth his salt is going to prevent you from making an emotional mistake during those times. And for most of my households, That's where I make about half of the earnings that I earn on that household over 10 years is once or twice during those bear markets, preventing people from making bad decisions. It's very much worth it. And the people that have made bad decisions in the past, they lost a lot more than any cost that they paid a financial planner. Good topic today, Zane. Let's keep them coming. And we look forward to seeing everybody next week. In the meantime, keep learning, keep planning.